Now onto the Federal Reserve part of the course. What we'll be doing here, we'll have another look at the Federal Reserve in terms of how they work, as we have done with other central banks, and this will lead up to a specified binary trade on your trading drill. So an opportunity to trade a Fed announcement in T-notes, and we'll have a look and prep that. But first up, a little bit of understanding of the Fed, which does work slightly differently to other central banks. Another very important thing to remember with the Fed, they are often the first to move and often the most aggressive. So let's move on. We'll go and have a look at a brief overview of the Fed. The Federal Reserve System was created in 1913. Now, prior to that, we had 12 different regional Federal Reserve banks that managed different parts of the United States and effectively were the central bank to the banks in their region. After 1913, these were all amalgamated into one system. Every bank has an individual chair, and each chair has a responsibility for making broader policy decisions at the FOMC meeting. I'll come on to what the FOMC is in a little bit. Now, you'll often hear that the Federal Reserve is privately owned, and you would think, well, that's not ideal if you're creating interest rate policy yet still have shareholders' interests to be looking after. It doesn't work the same as a normal company. What happens is every bank who is part of the Federal Reserve System, so has access to the Federal Reserve, has to own shares in the Federal Reserve. Now, these shares cannot be traded, they cannot be used as collateral, so they're in a sense quite nominal. But what this serves to do is create independence of the Fed from the government, but also maintain an independence in terms of the Fed not needing to look out for shareholders' interests, so not changing policy in order to benefit shareholders rather than the wider economy. On that initial comment, you got a spike up. So when it comes to how policy decisions are made, you have the 12 chairs of the banks. There is then also another committee, the Federal Reserve Board. Now, the Federal Reserve Board is appointed by government. These individual members appointed by government don't sit on any of the individual banks and serve a purpose of managing policy as a whole, along with the other 12 chairs. So we'll go on to how those members break down and how policy decisions are made in a moment. First though, what's the Fed's mandate? The Fed's mandate is what's known as a dual mandate. So to start with, they have their dual mandate of maximum employment and also stable prices. Furthermore, they have a mandate to moderate long-term interest rates for the US economy. Now, what this effectively all works out to mean is that interest rates are targeted at 2% over the medium term. This, like the Bank of England, is a symmetrical policy, i.e. you can go above it or below it, and either way should create a policy response, whereas for the ECB, going above it creates a much stronger policy response. Being below does not have quite the same impact. So let's go and have a quick look at what influences this longer run or medium term interest rate and why you get this interest rate shift, and a particular tool that the Fed focuses on quite heavily. The key focus of the Federal Reserve is the Phillips curve. Now, what the Phillips curve serves to do is show a relationship between unemployment and inflation, at least in the short term. In a short-term basis, lower unemployment leads to more inflation. As more people become employed, they get paid, they start spending more money, that causes prices to rise. Their wages also rise because companies are earning more money. But this also stokes inflation expectations, which then continues a cycle whereby the expectation of wage rises comes in. People demand higher wages. This then gets to a point that companies can't afford, and unemployment then starts to rise again, and this equalises. So what would effectively happen is, as unemployment falls, you move from point A to point B on the graph. Inflation has risen. Now, to move to point C, unemployment falls, yet inflation expectations remain, and so you end up with a new short-run Phillips curve. So in the short term, this holds. In the longer term, however, this relationship does not hold over a long period, resulting in a natural inflation rate. The natural inflation rate is a balanced rate where unemployment maintains at a relatively low level and also keeps inflation at an acceptable level as well. Now, this is what the Fed's aim is over the longer to medium term, to bring inflation in line with this natural rate by short-term adjustments in interest rate policy. These short-term adjustments can pull inflation rates in line by shifting inflation expectations, and that also influences unemployment as well. So that's partly where their dual mandate comes from, in their maximum employment and their stable price element. So that's a big focus for the Fed. You will often hear them talk about the natural rate. The natural rate is this longer run Phillips curve, whereby you don't have a relationship between unemployment and inflation, but you do have a natural rate of inflation and of unemployment. So that's the main focus for the Fed. They don't give you a specific number on this natural rate. However, they will talk about whether they are approaching or near that natural rate, and that's a guidance on how policy could change going forward.
We didn't get any new information. We didn't get anything new in the press conference either. The tone didn't.
We'll go and have a quick look at how exactly the Federal Reserve System works. Now, Congress oversees the whole thing, so they will call upon generally the Fed chair, and they will have to explain what's been going on recently to Congress at periodic times. Congress's main function is to choose the Board of Governors. Now, beyond that, you have two other arms of the Federal Reserve System. One is the FOMC, the Federal Open Market Committee. This is concerned with deciding on policy and how the policy is to be implemented. The 12 Federal Reserve banks are the ones that implement the policy in very much the same way that the individual central banks of Europe implement the policy of the ECB. The Federal Reserve banks implement the policy generated by the FOMC. So we're going to have a look at the members of the board of the FOMC and how they actually come to their decisions. So as you know, the Federal Reserve System is partly made up of the 12 Federal Reserve banks and the head or chair of each bank. You've then also got the Board of Governors on top of this, creating a full Federal Reserve System of heads of the Federal Reserve System of 19. Now, where you have a slight balancing out is the Federal Open Market Committee. Now, what you have here is the policy-making arm of the Federal Reserve System, and this is made up of the 7 members of the board, plus the head of the New York Federal Reserve. So the New York Fed's chair is always part of the FOMC, and then 4 of the other 11 remaining Federal Reserve banks. So the chairs of those then make up the FOMC. These are the people who have the decision-making process. They're listed in that graphic and highlighted in gold. Either they are members of the board or, as you can see, listed by the bank that they represent. Now, the Federal Reserve Board, or the FOMC I should say, doesn't have to operate with the full quota, and so I've listed members who are yet to be confirmed but are likely to be, so these being Bowman, Clarida and Goodfriend. So as of recording, they're not yet fully fledged members, but are in the process of being accepted as members. So for that reason, the Federal Reserve and the FOMC can operate without the full 12 and has done at various times for quite large periods of time. For instance as well, currently Dudley is actually on the board of the Federal Reserve as well as becoming the New York Fed's chair, so will still remain in that decision-making process.
of new information.
Now,
Confirmation of that
the
decision.
members of the
Those new
individual
positions
banks
jump in,
or the individual reserve banks,
get squeezed in
they
the
will
opposite
rotate.
direction
So the 4
trades-
that are part
traders
of
who've
the board
already
one
had
year
their position
may well
use
shift
those
the
new
next.
entrants
Crucial
and
thing to be
liquidity
looking at the
exit their
moment
existing
is
positions.
the distinct
The new
drop
entrants that get
towards the
squeezed in
hawkish
opposite
side for the
direction.
members who are actually part
So
of
what
the
we'll have a look
decision-making
at is look at
process.
two different examples
Of the
here, both
top
over the
6
Bank of England.
most dovish members of the Federal Reserve
One
System,
example of positioning
5 of them
into it,
don't actually have
whereby
any
that
voting
positioning
right
is then
on the FOMC, so can't
the move
directly
plays
influence
into that
policy.
positioning's
So
trade,
let's go and have a look
and
at how
you
those
then get
decisions are
squeezed
made
in
and
the
how
other
those
direction.
members who
And
can't
then
directly
the
influence
alternative
can still
where you
have
a
impact
technical
on
setup,
policy.
Positioning for that technical play that is then
In terms of the
squeezed
Fed
in the
coming to its
opposite
decisions,
direction
it does this
before
through 8
that
meetings
move
per
moves
year.
in the same way.
This used to be 12,
Now,
so 1 a month.
considerations
The Fed,
for these
as
types
with
of
many
trades.
other things, was the first to adopt
In your
this new
planning,
format whereby they do
this
8
over
meetings a
trade
year,
like this, and you can-
4 of
you
which
can plan
have
for a
staff
trade like
economic
this.
projections
In your
and
planning for it,
also
what
a
you
press
need to be
conference
thinking
whereby the chair
those
has
positions
the
go into
opportunity
exit?
to explain the decision
So
and also get
the
questioned on it.
positioning of the market, what are those people going
Now,
to do? So
unlike
put
a lot of the other
yourself
central
in
banks, the Fed
in there.
meetings last
What
2
would you
days.
do if
It's
you
the
had
day
that
before
position?
and the day
So
of.
where would those
This
people
is where
get?
discussions
And
happen
also,
and decisions
doing that,
are
you're answering
made.
the question
Now,
of where
these
that
meetings
squeeze
are attended
reach.
by all members
So,
of the
for
Federal
example,
Reserve
you may
System,
have short
including the
positions
12 members of the
at a
FOMC
level
who
a
actually
fair
have
bit
voting
higher up,
power. So those members
commensurate
who
with a
are
standard
chairs of the
central
Reserve
bank type
banks
move. So if
but
you're
are
looking
not in the
pound, for
voting
example,
rotation at the
something
moment
between
still have the
60 and
opportunity
100
to
ticks
influence
higher,
the
perhaps.
decision. However, they don't have
You could
the
be looking
ultimate
there
say
thinking, okay,
in what
well,
actually happens.
maybe
So
that's where the squeeze could go. The
if you
stocks
hear
get
statements
dragged
from
back up to
any
that
of these
point,
members,
then we can
you
take
should
approach.
know who is and who
Now,
is not a voter.
That's giving you a
The
little
ones
bit
who are
of
not
scope, a little bit of
voters,
idea of
their
where you might want to
their
try and
statements,
execute
if
a trade.
they put out a particularly hawkish or
Next
particularly
step
dovish
is
statement,
how
is
you
not going to be
execute
quite
that.
as
You've got
important.
one of two
Nonetheless,
options here.
remember that they do still
First
have
up,
influence,
this is more
and
a
what
case where
you will
you
often
have
get is
technical
statements from the
type
non-voting
positioning.
members
It's a
that
fake.
starts to sort of build a
The
story
idea of
towards
fake
what
is
the
if you-
overall
if you
board
get a
is
rush
thinking.
against that technical positioning, that's
In
gonna
terms
jump
of
to
the
a
actual
certain
release,
point,
so how
and
you
give
get
the
this
opportunity to
information,
go
you'll get an
straight against the
implementation
move.
statement which comes out at 7 o'clock UK time.
There's your first
This
trade there,
statement
and so
is
that's
released
a
as
very
well
quick,
on the
as we've
Federal
talked
Reserve
about before,
website,
quick
but it
jump
comes
up,
out
sell
on the
into
newswires
move
in
as it
terms of a
goes up.
screen dump,
The
so the
important
bullet
thing
pointing
here is that you don't get
of all
anything
the
from
relevant
central
points.
bank that
Remember,
is
as I've said before,
overtly
read this from the
advertised.
bottom
You
up.
don't really want a binary trade
After that, you will
situation.
then get the
You have a
full
very
statement
binary
at
type of
7:30,
situation.
along
That
with
could
Q&A
completely change the dynamic of the market.
on those quarterly
That's
decisions.
your first opportunity.
In terms of their blackout, the blackout runs from the second Saturday prior to the decision until the Thursday after the decision. So unlike many of the others, Fed members can't actually put out any statement regarding monetary policy after the decision either. So they can't then skew perhaps how the market views the decision. So the market is very much left to its own devices in how it interprets that decision.
And that's quite a common trade to see over a central bank where people jump on the first
The
piece of
Fed has got quite an
information,
extensive
and then
toolkit,
as more
but first up
information comes
comes
out,
open market
interpretation
operations.
changes,
These are
and that
used
takes
in
time
order
back
to achieve
through
the target
seeing
rate.
grind back through the
So
point
what the
where
Fed
the
produces is a target range
That's
of
your
interest
first
rates.
reversal,
So for example,
idea.
you would have a target rate of
alternative to that
1.25 to
is
1.5.
waiting for an
Now, the
asset
top and
to
bottom of
develop.
this
It's not
range
going
is
to
slightly
know exactly
different
where
from
that
many other
point's going
central
to be.
banks,
So
and the
£3
Fed
pounds
operates a floor
isn't really something
type
you can do.
interest
What you
rate
can
policy.
be thinking is
We'll
that
talk about
if
that
you
in the
get
next
that
slide in a
floor
little
type
bit more
move,
detail.
it's going to become a point
So
that
in their
allows you
target
into
range,
that
they will
trade.
have the
I'll try
bottom
and
of the
talk that
range
one
is
through
the
when we go
overnight
through
reverse
technical
repurchase rate.
squeeze and reversal
The top of the
in
range is the
coming
interest
slides.
paid on excess
Let's go and have
reserves.
a look at the first example of this, and this is
What they're aiming to do here
the Bank of
is
England,
to
where you
maintain
have the market
the federal
position
funds rate
itself
somewhere
into
in
the
between the
decision.
two. Now, the federal
Let's go and
funds
have a
rate
quick look at
is the rate that banks can borrow from each other, but they're borrowing and lending reserves that they hold at the Federal Reserve. So it's a market for bank reserves.
So what you can see here,
A bank that needs
we've had quite a rapid
more reserves in
going
terms of
into
meeting
that
their requirement
position.
will need to
Past
borrow
3
more on the Fed
days
funds
and including
market.
the morning of
Those
the
that have got
decision,
excess
the
funds
market's
in
rapidly
reserve
moved up
can then
to
lend them
around
on the Fed funds
130,
market as well.
140s.
The Fed will then inject money on a daily basis or withdraw money on a daily basis so as to balance this supply of cash in the market and that way achieve that target range.
In the expectation that the Bank of England
Beyond that, they have a discount rate as well. Now this, like other central banks, is a more punitive rate for banks that need cash on a sort of lender of last resort situation. They have two rates for this discount rate. They have the primary rate, and this prior to 2008 was the upper band of the Federal Reserve rates. And we'll talk about that in a little bit more detail in a moment, as I said. Now this is for borrowing for sound institutions who can post collateral. They will then receive cash at an interest rate of generally 0.5 above the Fed funds target rate. Now this can vary. The Fed can widen that corridor to the discount rate or narrow it in times of market stress. The point here being that banks that have to access the discount window are showing weakness, effectively, that they can't borrow from other banks through the federal funds market. And that's why they would go to the Fed in this instance to borrow. What would be seen as even worse is if they use the secondary discount rate. Now this is for an institution that can't access that primary rate. It's often used in extreme circumstances to avert some kind of market panic, to avert a credit crunch. So there is a large stigma attached to this second rate and the discount rate. Something that was focused on a lot in 2008. Banks that were needing to access this were implicitly showing that they were in quite a lot of trouble because other banks were not willing to lend to them. So the banks may well have known this, but to the outside world, this was then a very good sign that certain banks were coming into quite a bit of trouble. Now I spoke about reserve balances, and they're the balances that get traded in the federal funds market. The Federal Reserve does operate a reserve requirement system. So any bank that is able to deposit money at the Fed has to deposit a certain amount based upon their liabilities. Now this is a reasonably simple calculation for the Fed. Anything between 16 and 122 million in assets, the firm has to deposit 3%. Anything above that, the firm has to deposit 10%. So this has to be deposited in the form of cash. This creates the reserve balances, which are then traded in the federal funds market. At the end of each day, banks need to maintain their reserve requirements, so 10% for certain banks, or for the majority of banks, they need to remain at that 10% point. And so that's where they would then have to go into the federal funds market to borrow if they're not quite at that level. So let's go on. We'll talk about this floor system and how that's developed from the old corridor system and how exactly this now works and why we're actually in a situation of using this floor system. Okay, so let's move on to that.
The hard part of this trade then is how to enter.
Let's have a look at how the Fed's open market operations differ from other banks. Now, traditionally, they would have operated in very much the same way. You would have the discount rate forming the top band and the interest on reserves forming the bottom. Same as you would see from the ECB, from the Bank of England, from the Bank of Canada. However, with the advent of QE, this created so much more in terms of reserves at the Federal Reserve. So as you can see in the graph, the supply of Federal Reserves way outstripped demand, and so what happens is that federal funds rate drops, the blue line, as those reserves increase. Those reserves increased from 15 billion up to 2.6 trillion. So this is banks taking on some of that QE money and depositing it at the Fed to earn that interest. So there's no reason for them need to go out into the federal funds market to actually borrow a great deal of money. What this also resulted in then was the federal funds rate often actually dropping below the rate of the interest on excess reserves. This then creates an arbitrage opportunity, so anyone who can borrow below that rate, then deposits the money at the Fed.
22, 27 area.
And so what then happens is, because of this excess liquidity, you end up with the interest on excess reserves actually becoming a ceiling rather than the floor on rates, which then brought about a new type of strategy known as a floor-based implementation of open market operations and of their rates, which we'll go and have a little look at now.
You're starting to see the squeeze. People have entered.
So what the Fed then created was a floor and a subfloor, and that's what we use now.
Your entry point.
So when you see this target range of say 1.25 to 1.5, the subfloor is the rate of the overnight reverse repurchase operations. The upper level is the interest paid on excess reserves.
There's no clear level that you can.
So as I say, there was that opportunity for an arbitrage whereby if you can borrow below the IOER, the interest on excess reserves, you can then deposit this money at the Fed and earn that spread.
Now what you can see is that the market,
not all institutions can actually put money at the Fed and earn interest on it. Some government-sponsored entities cannot do this, yet they have a very large influence on the federal funds market. And so what they would be doing is actually lending money. If they had excess reserves, they'd be lending that below the federal funds rate. Banks would then take that money, arbitrage it, and invest it at the Fed for the IOER. So to prevent this level falling too far, the Fed then created the lower bound, which is the overnight reverse repurchase operation. Now how this works is, this is a collateralized operation, whereas the Fed funds transaction has no collateral, so it's an unsecured lending. So overnight you are only basing it on the trust that your counterparty is going to pay you back the money the next day. The overnight repurchase operation allows a greater number of institutions to actually earn interest by depositing money at the Fed, so a short-term loan to the Fed in exchange for collateral. So this then forms the lower bound. As federal funds rates start dropping, you can either lend unsecured or you can use the overnight repurchase operation and lend with security, with collateral directly to the Fed. That's why, as you can see in this chart, you actually got this one very quick dip, and this was after the Fed raised rates for the first time in 2015. This came towards year end, and what happened there is that banks and institutions wanted to show the best balance sheet they could when they reported at the end of the month. Now, if you've lent money unsecured through the Fed funds market, it is not going to be as good looking on your balance sheet because it would show up as a liability. Whereas if you lend via the overnight repurchase operation, you then have an asset on your balance sheet of that collateral from the Fed. So that's now created this bound. The Fed at the moment, since the beginning of these rate hikes, has been very successful in keeping within this bound. Now, the only time that this is likely to shift back and we then become focused on the discount rate or the prime rate is once we start seeing these excess reserves in the system start dissipating, which we'll come on to speaking about in a moment. The Fed is trying to wind those down. As they start winding them down, you may then get discussion of a shift away from this floor-based interest rate policy and a move back to the corridor-based, whereby interest on excess reserves would then become the lower bound and we'd then be back to looking at a prime rate. So that would suggest, if you get to that point, that they have ended their reduction in the excess liquidity that is within the system. So we'll discuss that in a little bit more detail coming up.
So that's how you'd be looking to try and play this.
Let's go and have a look at the Fed's historical toolkit. Now, when I'm talking you through this, the importance is not about the history of what the Fed's done. Yeah, ultimately, there's no trade in that. There's no real information there. But what it's providing, and you'll see this, the Fed has done this numerous times, is a template for how other central banks are likely to go about their programs, also how they're likely to come out of it. And that's where the Fed can help us out. They generally are the most aggressive and the fastest in implementing new stimulative policies. So first up, they were the first to start QE, and this was in November 2008. What they did was they had a set amount they were going to buy, and they were going to buy 600 billion of treasuries, not treasuries, mortgage-backed securities. These purchases were going to be sterilised, i.e. they would be in the form of a long-term repurchase operation, i.e. they would buy them from a bank and then at a later date sell them back to the bank. This was then advanced. In March 2009, the Fed upped this amount to 750 billion for mortgage-backed securities. So the reason for mortgage-backed securities was to help that mortgage market. That was the cause of the majority of problems during that 2008 crisis. They also decided to buy 300 billion of treasuries, therefore pushing down yields in the treasury markets, particularly in the short end. These were not going to be sterilised, and this was the beginning of full QE. So the Fed then printing money, increasing the size of its balance sheet and buying these securities. What they then did, QE2, they then moved on to a format of buying a set amount per month, and this is something that the ECB copied. The ECB copied very much the Fed's beginnings of QE. They started with purchases that were to be sterilised. These were then later left to not be sterilised, and then they started purchasing government bonds, treasuries in Europe, at a set amount per month. So the Fed did this in November 2010. They set out 600 billion of treasuries, and these were to be done at 75 billion a month. So therefore, 9 months worth of buying. These were also longer dated treasuries as well. The reason for this is with the buying of all the short end treasuries, you've got a yield curve that was actually getting quite steep. What was happening is the buying of short end treasuries dropped yields in the short end while still leaving yields in the long end higher up. So by going into the longer end of the market, the part of the market that affects more of the general lending in the economy, think about mortgage rates, think about bank loans, car loans. These are more linked to longer end rates because of the fact of the duration of these loans. So they then started buying treasuries in the longer end with the idea to actually start dropping longer end rates and bring this balance back into the yield curve. So your short end rates are already low, they then wanted to drop these long end rates as well. They furthered this in September 2011 by Operation Twist. Now what they did here is, through the ownership of shorter end bonds, these bonds eventually mature, as we know. So when the bond matures, the Fed gets paid back. What they did was then take this money and buy longer end bonds with it rather than reinvest it into short end bonds. So any bonds that matured, so that the Fed then got their money back on the bond that they owned, the Fed would then reinvest that money into the longer end. They also did sell some of their short end bonds as well, which served to push up yields in the short end a little bit and yields down in the long end. They then increased this as well. So first up they did 400 billion of this twist. They then increased that by another 267 billion in June 2012. And finally, QE3. This was done in September 2012. What they did here is, rather than having a set amount done at a certain amount per month, they went for effectively indefinite purchases. So they then said, right, we're going to buy 40 billion a month of treasuries, of mortgage-backed securities, 45 billion a month of treasuries. No time limit on this, So that was effectively indefinite QE. Something that the ECB has copied, but in a slightly different format. The ECB, by putting a date that the QE would end and then consistently extending that date, is effectively doing the same thing, creating indefinite buying. The only difference being that the ECB has never been explicit that their buying would be indefinite. And finally, tapering. This was announced in December 2013, and what the Fed decided to do is to reduce their purchases. They would reduce the amount they buy by 10 billion per month. Now remember, the key thing here is they're not actually stopping buying, they're just buying less per month. So this buying of treasuries still remains. And that's something that people perhaps misread on the tapering, that yes, they're dropping the amount they're buying, but they're still buying. It's only once we move on to them stopping reinvestments that they're actually completely rolling back how much they actually buy, and that's where you then start seeing a withdrawal from the treasury markets. So we're going to talk about that just now.
Is no longer there. That's very important, and that's what turns.
All this buying of treasuries has increased the Fed's balance sheet up to a level of around about $4.5 trillion. This was from a level of around about $1 trillion prior to the crisis. So they printed a huge amount more money, and they now own lots and lots more bonds. So what's going to happen now? They've stopped buying anymore, but what they're still doing is, as these bonds mature, they're reinvesting that money. So they maintain this buying in the treasury market. The only difference is it doesn't increase. Now the Fed finally, in 2017, set out its process for how it's going to wind this down, how it's going to get the balance sheet back down. They've not given a point to how far it's going to go. They've said that it won't go to levels that it was prior to the 2008 crisis, or even levels just after. So the general thinking is around about $2.5 trillion. So the Fed set out very clear guidelines on how it's going to do this. And this was announced in October 2017, following a schedule that they laid out in July. So what they intend on doing is reducing initially by just 10 billion a month. This will then slowly increase until we get to a point where they're reducing treasuries by 30 billion a month and agency securities, so mortgage-backed securities, by 20 billion a month. This at the moment has no end date. And so they will continue this reduction until they feel that they have reduced enough. This could well be the point that they then, having reduced that excess liquidity in the system, revert back to a corridor type rate system, and we then start seeing just one rate published per month, as we used to see prior to 2008. So that could be your signal that they have stopped this balance sheet reduction, and so that level of reduction is the amount that they are going to maintain as the Fed's overall balance sheet. So that should be your big clue to it. At the minute, as I say, $2.5 trillion even is the expected amount that they are to drop to. But this is going to take some time. And in words of Janet Yellen, who was the chair at the time that they started this reduction wind down process, actually said that this process will be like watching paint dry. Now, if you think about it, $4.5 trillion reduced by 50 billion a month is going to take some time to actually wind down. So let's go and have a look at what the impact this had on the balance sheet. Here's the Fed's balance sheet since the beginning of this wind down of the balance sheet. Now, what you can see is we started to drop, and this was actually coming into the end of 2016. Now, the reason for these fluctuations in balance sheet is because treasuries and other securities will roll off, so the Fed will get the money in. However, they won't necessarily be able to reinvest that because perhaps there aren't any treasuries available to buy, or there aren't enough to be available to buy. That's why you get these short-term fluctuations. So the real drop is just that very last part of the graph. This is from that October through towards the end of 2017. You can see the purple line is the Fed rates rising progressively, but the impact that this has had is very, very small. We've dropped from 4.463 trillion down to 4.442 trillion. So we've dropped 20 billion in that period. Not a great deal in terms of the balance sheet. However, this is then going to increase in pace as the months go by, and we should see that further fall.
And as it breaks through, potentially...
And if we have a look at a longer dated chart, you can see how marginal this impact so far has been. The balance sheet, in fact, peaked at the end of January 2015, the year prior to the first hike at the end of December 2015. Now, what I've also got, the vertical lines you can see on the chart, indicate how that balance sheet grew throughout the different phases of QE. So QE 1, 2 and 3. QE3 was that indefinite phase, and that's what really increased that balance sheet up from around about the 2 trillion right up to the mid 4 trillion area. So that's what we've seen historically. Fed rates are starting to build up slowly. Now, something that I think is quite a good point to think about here. The Fed now has 8 meetings a year, and so far has been reluctant to raise rates on anything other than the quarter end. Historically, what has happened in 2005-06 and the build-up prior to the crisis is we saw rate hikes come in every single month, and this at one point was 14 months in a row. So at the moment, people have this sense that a rate hike or a normal phasing of rate hikes would be perhaps 4 a year is the maximum that you could expect. However, if you take this back 10 years, we saw 12 in a year, so this could be an area that people perhaps aren't even thinking about, and something that I think you should keep in mind, that a pickup in pace of rate hikes is entirely plausible. The way the Fed could go about this is by issuing a statement saying that they will hold a press conference at every meeting. This would then make every meeting seem live, and the possibility that you could in fact get 8 rate hikes in a year. So something just to think about when you look at how rate hikes have begun so far, and just think about how this could actually switch back to something that we have seen historically.
What typically happens after the first
So we'll now move on. We understand the toolkit. You've seen all the tools that the Fed has got in their arsenal. We'll now move on to how they've actually communicated these and where you can actually start pulling trades out, looking back at previous Fed statements, and also on those screen dumps, where exactly you get the opportunity to trade.
Holding above 20 is trading up to 50. So if you're looking
First up in Fed communication, we'll have a look at their forward guidance. Now, they don't have an explicit forward guidance anymore. We'll look at how theirs developed and how they still do maintain a degree of forward guidance. So again, Fed was one of the first to do this, and then this became a little bit of a template for other central banks. 2008 it started. After they cut rates to 0, they put a line in their statement saying that exceptionally low levels of the Fed funds rate for some time. Not clear on how long, but they continued to use this phrase. Later on, come August 2011, they changed this and actually put a date on it. This way, giving the market a sense of how much longer they were going to have these virtually 0 rates, and then where rates or when rates were going to rise. So it became date contingent, and this exceptionally low levels of Fed funds rate changed to through mid-2013. This was then advanced to late 2014 and then also to mid-2015. So this has been a line that the Fed has kept for some time and continue to update, giving the market a sense of when it's, well, in fact here, when it's not going to raise rates as it was, because they continually push this back and back and back. 2012 they added a data contingency as well. So what they started to do here is suggest that as unemployment rate started dropping, they would then consider raising rates. So the exceptionally low level of Fed funds rate would be appropriate until they see unemployment below 6.5%. However, they then started to change this, and it was rather than until the unemployment is below 6.5%, it became until unemployment is well past 6.5%. So then opens up ambiguity as to how low unemployment's got to fall before they're willing to raise rates. As it happened, before they raised rates, unemployment fell, close to 4% before they actually started to raise rates. And finally, they then dropped the data contingency, because what this was serving to do was make certain economic data extremely sensitive.
So the first attempt
and
is not there.
this provided new opportunities, but over unemployment numbers for the US, what you would actually have is markets moving the wrong way, if you will. So a good unemployment number would actually cause the S&P to fall, because this lower unemployment would imply a rate hike coming soon. So actually equity markets took this bad, and so you ended up having to trade numbers the wrong way, if you will. They dropped this, and come March 2014 they became asset purchase program contingent, something that the ECB is currently in the phase of. So we can learn a lot about how the Fed comes out of this, and at what point they stopped referencing the asset purchase program and then started to actually move into a rate hiking cycle. So they stated in 2014 that the federal funds rate would be appropriate for considerable time after the asset purchase program ended, especially if inflation runs below 2%. It then took the Fed a full year and 9 months to actually raise rates after that point. So quite some time to actually do this. Remember, they hadn't actually finished their asset purchases until the end of October 2014. So in fact, it took a year and 3 months before a hike. Something that perhaps we could be thinking about for the ECB, which currently it would seem that their asset purchases are likely to end at the end of 2018, and a rate hike could well be coming mid-2018. So at the time of speaking, that's the view of the ECB. As time goes on, if you follow the Fed's line of movement, it could well be a year and a bit following the end of QE for the ECB before something happens. So the Fed's communication possibly giving a template for how other central banks then move going forward. Let's go and have a look now at how the statements break down and what areas of the statement you need to be reading through to understand where possible changes could be coming for the Fed at future meetings. We'll now go and have a look at how the Fed guides the market nowadays. Now, the way they do this is via their statement. They've always issued a statement. They don't put any explicit forward guidance in, as I've already mentioned. So it's all about how you dissect the statement. Now, going into any Fed meeting, what you need to be doing is reading through the last 2-3 statements to understand how policy has evolved, how their thinking has evolved, and their view of certain areas has evolved. Put these into a table and you start, as we've seen with other central banks, building up a picture of where potentially they could change things in order to give a new view on their way of moving rates going forward. So first up, beginning of the statement starts up with an assessment of their current situations. So this is just their view of what's happened since the last meeting. It's not necessarily indicative of what they're thinking going forward and what's going to actually influence their rate changes. Focus here needs to be on inflation and inflation expectations. To start with, they will talk about job gains and employment. Now, at the moment, these are not so focal areas. There could become a time where this becomes focal. But going into 2017-18, it's all about the inflation side of things. So they give a 12-month basis, so a short-term inflation view. And in the December 2017 statement, they said that both overall inflation and inflation in terms of items other than food and energy have declined this year and are running below 2%. So that's your inflation and your core inflation running below 2%. They then talk about longer term expectations, and these are little changed. So that's the current situation. They now go on to talk about how they think this is likely to develop. Now, this is the key bit. This is the bit where you get a sense of whether they feel things are improving, in which case a rate hike becomes a little bit more likely. So their expectation of inflation and growth. They will start this off in a very consistent way with the word consistent and talk about their mandate. What then happens is they will talk about gradual adjustments in the stance of monetary policy for economic activity to expand at a moderate pace. Again, inflation becomes key here. So you're looking at where they view that 12-month inflation going. So inflation on a 12-month basis is expected to remain somewhat below 2%. Near-term risks to the economic outlook appear roughly balanced, and the committee is monitoring inflation developments closely. So the key things here are how they view inflation going forward. So at the moment, at this point, they viewed it as somewhat below 2% and expect it to remain there. The other key point is on their outlook. And they use two words here, roughly balanced, to describe the outlook. This has been used in the past as a way of guiding the market forward into a rate hike. Prior to the first hike at the end of 2015, the Fed in meetings before started to use the phrase nearly balanced, then they moved to roughly balanced, and then they hiked and stated that outlook is now balanced. So this became a sort of guiding as to when the rate hike's coming. They've not since used that and retained this roughly balanced phrase. However, any change in that, for those who remember back to 2015, will be seen as some kind of shift in policy stance, either towards hiking rates further or a move away from that and perhaps slowing down in any rate hikes. So this second paragraph's key. These bits come out in the screen dump of the statement as well. So that's what you're going to be focusing on in that screen dump. We'll move on, have a look at the second part and what the implications of that are. The second part of the Fed statement is generally reasonably unchanged, and certainly a lot of the format is extremely consistent. To start up, they talk about how they've changed rates. Now, you'll know this, that'd be the first thing you see on the decision. However, it's their reference to their stance of monetary policy that's important. In December 2017, this was regarded as accommodative. It's the way this changes that's going to be key. So if they swap accommodative for, say, neutral, this implies they've now got to a stage where rates don't need to go up nor down in order to keep inflation around about their medium-term 2% target. So depending upon how you've got to the move to, say, neutral, will influence the market's reaction. If you've been rate hiking and then it becomes neutral, that basically says that we're not going to see any more rate hikes or any faster rate hikes. So therefore, this could be seen as quite good news for the market. All about how you come into this. Now, I use the example of neutral. The word that could substitute in for accommodative could be anything. And the discussion around this is likely to heat up in news reports, in bank reports, coming into any of these decisions. So that's where you'll understand what to expect. And so rather than just think, oh, it's neutral's the word, read up on it as you would with any central bank, understand what the rest of the market is thinking. Now, the final paragraph is almost always the same. This is where they used to put in their reference to forward guidance. And they also talk about the longer run and their data dependence. So the main area that could potentially change here is that the committee expects economic conditions will evolve in a manner that will warrant gradual increases in the Fed funds rate. That is their forward guidance, so to speak, the gradual increases. So that's the changeable part. Beyond that, they reference Fed funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. So again, this is one changeable part, but if they change this, you're likely to have already seen that accommodative changed anyway, but do watch out for their reference to levels in the longer term. And finally, they reiterate their data dependence. So any movement will depend on economic data and the economic outlook. So that's how they will come to any further decisions. This, as I say, is very consistent, is generally very unlikely to change. It would be a surprise for the Fed to just move away from looking at data and go, okay, we're just going to change rates on anything now. So that area is unlikely to change. It's the gradual part, and then whether rates are expected to stay below what's expected to prevail in the longer term, or whether they have reached those levels. So a couple of changeable areas there, but that very much later on, and an area that has been very, very slow to change historically. The way the Fed can provide the clearest indication on where rates are likely to move going forward is through their dot plot. Now, what the dot plot serves to do is give you a median estimate of where rates are expected to be at the end of the current year and the following 2 years, followed as well by the longer run. So how do they come up with this? What happens is every member issues an anonymous vote on where they believe rates should be at those different time intervals. So this is every member. It is not just the voting ones, it is every single member. The median of this then shows you where the expectation of rates is going forward. This the Fed can use then to guide the market. You know, if the Fed dots suggest that there's going to be 4 hikes by the end of the year, then you can start thinking, well, perhaps on every meeting with staff economic projections and a press conference, we are likely to be considering a rate hike. Likewise, the dots can drop lower and then guide the market that perhaps the rate hikes that we were expecting are no longer there. So that's the really important thing. How these dots move provides not only a very clear view of where rates are expected to move to, but also provides you a very, very clean-cut trade opportunity. Not quite as clean as the rate, that's a very binary decision, but this, in terms of the dots, you get a specified binary trade. So you get a situation where they could move one dot and perhaps not another. So they might move the 2018 dot and not the 2019, the implications of which are different to, say, if they moved all the dots. So you have to think through each year's dot, how that could move in terms of formulating your trade idea. And this will also influence how far you think the move could go as well. If they shift all dots higher, then this implies not only rates to go higher sooner, but rates to go higher at a faster pace over a longer period as well. One other thing to consider with dots: have a look at the previous dot plots. What you need to understand here is how many dots need to move in order to shift that median expectation. For example, if you're in a situation where it's only going to take 2 voters to move their dot higher to imply a rate hike going forward, then perhaps that increase in that year is not quite as important as one where it would require maybe 5 or 6 members to actually increase their estimate of rates. That way, again, you start to understand the implication and the importance of which dot is going to move. So think about these dot plots. They're very easy to find. You can put them into any search engine and you'll be able to find the dot plot of the previous meetings, usually with the prior dot plot attached to it. So what we have here is the September plot and then also the dot plot for December. As you can see, rates did increase in December and all members had pretty much voted for that in terms of their anonymous dot estimate. It's then going forward where you can see dots changing that is the important part. So we'll go and have a look at how that comes out on the screen dump, how you would interpret that, because you don't get it as how every member voted, you just get a median projection. So we'll go and have a look at the screen dump release now and how exactly you can interpret that release. So here's how the Fed statement comes out in the screen release. So this is what you get at 7 o'clock in the evening, UK time. The dots are released as part of the Fed's staff economic projections. So along with the dots, you will also get projections on GDP, unemployment, and inflation. Now the order these comes out is quite important. First up, you will get the dots, and these are referred to as the median view of the appropriate federal funds rate. And then they will list them at the end of each year, along with the previous in brackets. So you're looking at the change between the previous and what they're now expected at. So in this case, end of 2018, for example, median expectation was a rate of 2.125, previous 2.125. So that's implying that come the end of 2018, rates would be in the boundary of 2 to 2.25%. You will then usually, as well, the Newswire will give an interpretation of this. So policymakers are looking for 3 hikes in 2018. That's what's implied by the dots. So that's the first point that you want to be looking at. Beyond that, you then get the forecasts of GDP, unemployment, and inflation, which if the dots are unchanged, the shift in these is the next point that you want to be looking at. Anything outside of the estimates is going to be a sense that perhaps rates need to rise, rates need to fall. So that becomes your next area to look at. After that, then comes the references to the language, their discussion of inflation, the outlook, and occasionally you will also get the vote breakdown. So in this case, vote in favour of policy was 7-2. Note, only 9 members voted here. That's because the Fed hadn't got a full board at the time. As I said before, it can still operate without that full board. So that's how you get it when you get the staff economic projection. So it's all rate, then dots, then projections is the order that it comes in, and that is the order that you should be viewing this in as well in terms of importance. So rates, dots, projections. If the dots have shifted significantly, the wording is unlikely to have a great deal of impact, and something that you can look through almost, that the main move is going to happen based on the dots, not based on the wording. Here's a look at the T-note and the euro, how they traded over that screen dump that I just showed you. Now the dots are unchanged. There was a small expectation that some of the dots could actually be increased, implying more rate hikes going forward. So this is what the markets went off. Unchanged dots, T-note gets bought up for 8 handles, euro gets bought up 30 ticks. Very quick moves. However, they then both reversed. The reason for this, and those of you who are looking at the actual staff economic projections may well have noticed that GDP and unemployment were both improved. So GDP was expected to rise in coming years, unemployment expected to fall. And for this reason, you then got the turnaround. So this is why that priority is so important. Rates first, dots next, economic projections, then language when you have these quarterly reports. So what's happened there is the market has shot up, and then more people have started to look a little bit deeper into this and realise that actually this improvement going forward could well stoke more inflation and bring about more rate hikes in the future. That's why you get the turnaround. But remember, with all of these events, you do get a little bit more time than you think. The T-note and the euro both take a full 3 minutes to get back to where they started. So you get time to realise that perhaps you should be getting out of this trade because of the additional information that you are getting. So be very aware of that when you get in. Look through the rest of the statement as well to see if there's anything that contradicts the position that you may well have. If it does, then you've got reason to be getting out. What happens after that is, after the pullback, you then get a grind back higher. And this is on the realization that even though the Fed believes that the economy is going to improve, that GDP is going to increase, that unemployment is going to fall going forward, still they are not willing to change their view of how many rate hikes are likely to be coming. Furthermore, inflation has not changed either, or their estimates of inflation have not changed, and that's really their key measure. And so that's why we get this drop back down, then followed by an increase higher as participants realise that even with that improvement, the Fed is still less likely to raise rates. Now, go and have a replay of this. See how each market trades, which will help you out and give you a little bit of practice or familiarisation for the drill coming up. So replay times 13th of December 2017. Start time 6:59 and 30 seconds. Now remember to pause after you've started so you can set your ladders up. You want a T-note ladder, which is TYH8, and a Euro ladder 6EZ7. The reason for the 8 and the 7 is the T-note had rolled, the Euro had not at this period in time. Go and have a replay of those, have a trade of them, and what you want to be looking out for is, first up, is it possible and how would you get in on that first move? So that's your hit and hold trade, which then turns into a fade because of the fact that new information is preventing that continuing. Can you get in on a fade? So look at how the price action differs at the top, giving you a clue to actually sell the market back down. And then watch the slower grind. So can you get on a passive continuation trade for that move back up? So have a go at trading those. Note down the price action, note down how the market trades. First up in terms of speed, but then the slowing down of speed and as the selling comes in for that reversal type pattern. So have a look at that. This, as I say, will familiarise yourself ready for the drill coming up. It's very good practice to have a go, trade it over and over. You'll pick up different things every time you trade it. So we'll now move on. We'll have a look at screen dumps that occur without a staff economic projection and what you would need to be looking out for in those.
Okay guys, so we've got around about 15 seconds to go until the Fed decision. Now remember, not a huge amount of expectation here, but there is some that they could raise the dots, indicating further rate hikes going forward. So unchanged on the dots is the thing to be watching for a spike up in both the T-note and the Euro on the right. Here comes the result. T-note, Euro straight up, all the way up to 08s from 80s. T-note as well up to 15s. But remember, there were those other pieces of information on the dots, the other staff economic projections that were suggesting that improvements in unemployment, improvements in GDP. You can see the T-note is now all the way back to where it started at 10s already. The Euro has flicked back towards 88, but it's holding this low volume area. Now on that first jump, what you saw was very, very fast up to 8, but anything that came back, 99s to 96 was the area where this market stalled. The T-note move was so quick to get back, doesn't provide you a great deal of opportunity to fade this. So what you're looking for now, in terms of trying to play this back, you've now had the time to interpret the information. We've seen that we've got that improved GDP forecast, the improved unemployment forecast. What we're now looking for is the potential for this to reverse the entire move. As we've seen in previous examples, the market now starts to sit in a range between 97s and 91. So what you're doing now is establishing an area that is going to break, the break of which is going to give you your next leg of direction. So short 97 at the moment. To add on to this trade, for the breakout reversal trade, you're looking for a break through 91. So you want to see the pace increase, but at the moment, every time we get there, ticks towards 91 and then bounces very quickly away. You want to see the market fall onto 91 and hold there. Target wise, you're going to be looking all the way back to where we started, so back down in towards the low 80s and mid 70s. We started this move off with the Euro trading around about 117.78. So here we go, little splash down towards 91. That's a bit of a better sign. And we see now push through 91 here. Are we getting any more buying? This is the question. We don't see it. This time we actually sustain that selling. Now this pace starts to accelerate. Remember, we're looking down to where we started through this area of low volume. At the same time, the T-note is now back towards its scene of the crime as well. So this could be an area as a trade to look for a buy back at the scene of the crime, or the place where the market started to move. You've achieved the full reversal in the euro now, down towards 78s. And this, as I mentioned in the setup to it, is where you can then start looking for the passive continuation type trade. Have we got an opportunity to buy that scene of the crime, then looking for a continuation higher? Ultimately, the unchanged in dots is what's going to take over. Yes, we've seen some forecasts shifted, but if they're not willing to shift the dots to align with the improvement in GDP and the improvement in unemployment, then it suggests the Fed is still unwilling to really push forward with any kind of rate hikes. We're just at the moment seeing the euro starting to tick through 78, so we're actually starting now from the chart point of view just to push through and start a potential move lower. This is going to bring sellers in. This is going to get people thinking, yep, there may be a bit more in this, that they've got an opportunity to the downside. So unlike the T-note, which just gives you a very clean passive continuation trade to buy the scene of the crime down at 09.5, 10s area, the euro is traded down towards 68. We need to see it back above 78. That's where you're going to get the opportunity to buy. So at the moment, T-note sitting at half a tick offside. That's not too much of an issue. Euro, you don't yet have the opportunity to buy this. But what you've got to be thinking is people are going to start selling this. They would have sold it back through those 78s looking for a break lower. And it's those people who are now short starting to get out that causes this next rush up. So you get the rush up towards 88. This is where you're now looking for the next leg of the move. This is now a situation where you've got to assess what you're trying to get out of this. Are you trying to catch out those shorts who sold it through the scene of the crime, or are you trying just to take a much larger move? Are you trying to play for the bigger move to try and actually take out the recent highs? If you're just trying to catch out the shorts, then that initial spike up towards 88 was enough. And that exhaustion, that fast move up, was the indication that the shorts have been caught out. If you're looking for the larger move, however, staying long as we're above 78 is still a valid trade. The T-note at the same point is still ticking higher. So the T-note suggesting that it's still got some strength, which should then also translate into the euro. So this is where now, having got your passive position or your passive entry on, we're going to expect a more steady move. And this is also something to be really keeping in the back of your mind. Expectations of what the move's going to be like. Much more steady is your expectation here. So we can still be looking for the euro back up towards the 91 area, that point where we broke down to, or down from. That's the point that you'd at least expect the initial stalling. You know, if this is going to stall anywhere, the point where we turned back from could be where you get more sellers. The T-note, on the other hand, we saw it getting stuck around 12 to 14 area, and so that's then the area where you see it from the chart. We stall once more for another 45 minutes. So we're not going to look through this for the entirety of those 45 minutes. But the initial move off that scene of the crime, you're looking back to the reference points that you established as the first bit of trade happened. And that's what's so important. You've got to watch what's actually happening in the event to understand where you're going to get other reference points as you're taking these trades on, or as you get on to the next leg of the trade. So those 90s are now very important in the euro, because that was the point that the breakdown came from. The T-note, 12 to 14, that was the point where we got a little bit of battle on the initial move, and so again you could expect something similar again. Euro's now pushing up towards 90s, 91s, and there you are, you see that quick reaction from it. This is where those trying to take a bit of profit are just going to be looking for a quick exit around 91 and still using that as a reference point. Once that breaks, then you have the opportunity for the larger continuation move. The fuller move doesn't actually come much like the T-note until around 45 minutes later, When you get a flag break, you get a breakout of the range that gets established once more between 97s down towards, in this case, 85s. But we establish a range, and then when that breaks the flag as well, breaks that small range, and that then enables the continuation of this move. So in terms of what you're looking for, as I said, watch out for where you could play that reversal trade. The euro, it shows up very nicely around 70. That was where you got your reversal trade or your fade opportunity. The T-note was much quicker on the pullback there. But not only that, you then got the passive entry as well. Once we got back down towards that scene of the crime, both the T-note and the euro, that provided you an opportunity to get long, to then start looking for that larger move. We're now back towards those 97s as well in the euro, as you can see. So they were the trades to be looking for. In this situation, we didn't have too much change from the Fed, and so it was a bit of an interpretation element that you had the dots followed by those SEPs, and so that then gave you the specified binary trade on the dots and then the variable outcome trade on the SEPs, which took the dots move back. And that's the result of this, at least the initial 5 to 8 minutes of this move. After that, it was then a much more steady continuation type trade, which required a lot more patience to be able to stay in this trade.
You get a much more limited release when you don't have the staff economic projections. And what can help you out here is the newswires will often put in a reference to drops or repeats. So this immediately draws your eye to where you need to be looking. If they use the phrase drop or repeat, then you know that something has possibly changed and gives you a clue as to where there could well be a trade. So this from January 2018, the key bit to be looking for, as with any of these screen dumps, that first bit on inflation. Now this is the Fed's expectations. This isn't their current view, this is their expectations phrase. And so that second line after the rate, inflation on a 12-month basis is expected to move up this year, drops language on expecting inflation to remain below 2% in the near term. So what that's suggesting is that actually rates are going to move up, and in the near term they could well move to 2% quite quickly. This would be deemed as rather hawkish, but it's by focusing on the use of drops that you can quickly pick that bit of information up, and that's what gives you a trade very quickly. So with the language side of things, it's all about efficiency. It's all about drawing your eyes to things or knowing what exactly to be looking for. They next use the phrase repeats, and that's the repeats, the near-term risks to the economy appear roughly balanced. So that roughly balanced line stays in once again. They're the key areas to be looking for. Watch out for drops and repeats. But in terms of the lines that you're looking for that 12-month inflation. Overall inflation as well you're looking for. And as I say, that is around about it. These screen dumps are very, very limited in what you get from it. However, if anything is to change, they will make this reasonably clear, often with the use of the words drops or repeats. So going into this, it's all about go back through these previous screen dumps, look at the phrasing or the order with which the language appears, and then where exactly you need to be looking. Train your eyes to look at certain points. Always look at the bottom first and read up, but also then if you can look at how the sentences are structured, you'll know which part of a sentence to actually be looking for as well. All about creating efficiencies, those marginal differences that could make you one tick better off, and in a move that moves 10, that's 10% better off just for being more efficient in how you read something. So that's their use of drops and repeats. As I say, the newswires will usually put these in to signal where the important areas are. The final communication the Fed has after any decision comes 3 weeks later in the form of minutes. So you get the minutes describing the discussion that happened at the meeting prior. Now, what you're looking out for here is the words used to describe how members viewed certain subjects. So they will use a few, many, all, generally, and several. These have varying implications. Obviously, you can probably follow a reasonably clean line of few, several, many, generally, and all is varying degrees of conviction or varying degrees of number of members that felt a certain way about things. Now, where you need to be aware on the minutes is conflicting information. So if you see a few, straight away you can think, well, this isn't that well, a few are considering something, but it's perhaps not that majorly important, because the fact it's not going to take many to go the other way. And we see this in that first or the second line. The few felt that the median projections, so they will discuss any staff economic projections, published in December would bring too many rate hikes. However, a few others felt that more hikes could be needed in 2018. So you get these conflicting views. So if you go straight in on the first thing, you can often end up with a market that goes the other way as people look at the rest of that sentence. So the minutes are a lot more a situation to interpret the whole thing before deciding on what the implication of the whole minutes is for the trade. Obviously, if you get one shift to, say for example, the dots had not changed yet, many felt that they could be changed in the coming months, then that's showing that pretty quickly we could see a change in dots, and for this reason that would then be quite a clean-cut trade. You'll get reference to inflation, so in this case they generally saw inflation as little changed. However, several were concerned about persistently weak inflation. What the minutes also serve to do is flag up areas that may well become part of statements or discussed in more detail in policy going forward, and this is reference to the tax cuts. You see the two pink highlights, many, and this is policymakers discussing upcoming tax cuts and how they could affect the labour market, how could they affect the potential in the economy. So this is an area that could well start coming up in future statements. So the minutes not only serve to give a view of how we got to where we are, but also serve to give you an idea of things that could come up in the future that potentially, if they drop in something about tax in the next statement, then that's a focus for the Fed, and a reference to how tax could impact on the economy going forward could well be very, very important. So that's what you're looking for the minutes. As I say, this is more of an interpretation trade. You don't get any facts, but also one other very important thing to remember. The minutes are backwards looking, of course. We know what's happened. This is just giving you a little bit more detail as to how close some of these decisions were. And that's what you're trying to gauge, the closeness of these decisions, how likely it is that very few more people would have to do something to shift a decision. So yeah, will it only take a few at the next meeting to shift to a view that inflation is expected to rise faster? That's what you're trying to gauge from the minutes. But nonetheless, it will still give you a trade. There will be a hawkish or a dovish bias to the minutes, and that's what you're looking out for. That's why taking a bit of time to interpret and then trading afterwards is often a slightly better trading strategy, rather than to try and hit something. The minutes don't provide you with a binary or specified binary trade. Therefore, they allow you a little bit more time to consider how you can trade the market, where the market can then move from there. Outside of the scheduled Fed decision meetings, there are also a couple of other times when the Fed comes to explain decisions, explain their views on the economy, and also explain their views on how monetary policy is likely to move going forward. These come in the form of two testimonies to Congress and the Senate, First up, there's the semi-annual testimony to Congress. This is known as the Humphrey-Hawkins testimony. Reason for this, it comes from the Humphrey-Hawkins Full Employment Act of 1978. This mandates the Fed to produce a report to Congress and to the Senate on a biannual basis. So these happen in February and July. And what happens is the Fed chair will talk for a statement to Congress and the Senate, and then there will be Q&A with politicians afterwards. Now, the aim of this is to update on economic conditions and monetary policy. The Q&A for this can often be a little bit convoluted in where exactly it's going. So from a market moving perspective, may not always offer too many opportunities because of the fact that politicians will ask questions relating to their constituencies, relating to things that are going on in their regions, and not necessarily about monetary policy or the economy as a whole. So there may well be a lot of questioning that doesn't actually have any major impact. Nonetheless, this is still an opportunity for the Fed chair to give more guidance, potentially if they feel that their current guidance or the current view of the market of policy going forward is wrong. The Fed chair can use these opportunities to perhaps steer the market one way or another. Key to remember here is you get this over 2 days. So one day is to Congress, one day is to the Senate. Generally, the statements are identical. The statements are released just prior to the actual reading of the statement as well. This is to stop any conflict whereby people may see the statement before it actually gets read out. So it is released as a screen dump text prior to the actual committee hearing. But 2 days in a row, so potential for a change, but it is highly unlikely that you're actually going to see that. Now, next up, there is the testimony to the Joint Economic Committee. This is delivered in May and November. Again, this is another update on the economy, and again with Q&A. This is perhaps a little bit more focused Q&A because of the fact there is a committee that is tasked to look at the economy. And so the Q&A questioning can be a little bit more focused, and you may well get a little bit more market sensitive information coming out of this. In fact, this was the time when Ben Bernanke announced tapering. He suggested that tapering could well start in one of the next 2 meetings. This was in May 2013. Tapering didn't in fact start until December 2013. And what had happened is, following that statement, markets got very, very active. They got very risk averse as well. So you saw money pouring out of equity markets, pouring out of bond markets as well, as people feared that this would be the end of bond buying. For that reason, the Fed then pushed that back, and it then took until December to actually get the tapering into play. And this is what was known as the taper tantrum, a period whereby the markets got very worried about tapering, and you started to see asset prices declining because of this indication at that Joint Economic Committee meeting that the Fed could well start tapering in one of the next 2 meetings. So potential to get some very important information coming out of this. In terms of the way you prepare for it, very much the same way that you would prepare for any release on a central bank decision. So go through previous statements, understand the areas that could change, understand how data has changed going into this as well. And that way you'll at least be able to pick out, as the statement comes down, the areas that you want to be looking at. You obviously will not get any rates or staff economic projections, so this is very much an interpretation exercise. So one whereby you're looking really to compare the most recent monetary policy statement to what the statement is at the committee hearings. That is your best gauge of whether things are changing or whether they are not. Okay, so we now know everything you need to know about the Fed. Hopefully you understand the tools that they use, how they communicate, and can start thinking about where you want to be looking for that information as you get those screen dumps, as you get the statements. So we'll now move on to a drill. This drill is a specified binary drill. So I'll explain a little bit more in a moment, and we'll also have a look through a couple of charts before you get to the preparation as well.
Humphrey Hawkins was once again used as an opportunity for the Fed to guide their next policy decision going forward. Now, in July 2019, the Fed was moving into a much more dovish tone. We'd seen this coming on the back of the rate hike that happened at the end of 2018, and then the Fed sort of stepping back from that rate hike as the year progressed, as trade tensions increased, as we started to see inflation dipping at the beginning part of the year. And so we saw this reflected in the language that the Fed used as well. Powell, who's Fed chairman now, is quite keen to use previous conferences or small press conferences to start to bring in new language, and this we saw in January. He referenced in a press conference in early January the word patience in how it would determine rates going forward. This was then a word that could well have been introduced into the Fed statement, and that's exactly what we got. In January, following the rate hike in December, the Fed dropped their language suggesting that the risk to the outlook was roughly balanced and that gradual rate hikes would be needed. Instead, they shifted to they will be patient in determining the path of future adjustments in rates. This suggested that there were no more rate hikes coming anytime soon, and that the next move was as likely to be up as it was to be down. Therefore, we're starting to see a slight dovish tone shift, not necessarily indicating we're going to get a rate cut, of course. In March, trade tensions had been returning, the economy is still getting worse, and inflation is still falling. The big focus here, now remember this is a quarterly meeting, the Fed then shifted the dots here. And the shift in dots was quite significant. We saw a shift in the dots to suggest that there would be no hike at all in 2019. This is a shift from December, where we were expecting 2 hikes for 2019. Likewise, the dots for 2020 were indicating still an increase in 2020, so 1 hike in 2020, but from a much lower rate. As in December, you were looking for dots to indicate 2 hikes in 2019 and a further hike in 2020, whereas now there is shifting to no hikes and then 1 more in 2020. So whilst the 1 hike in 2020 still remained the same, it was the base from which that hike was coming from that was now significantly lower. The Fed also started to suggest that they would begin running off their balance sheet. So the reinvestments that they've been doing and the reduction in those reinvestments, the Fed now suggesting that they would actually stop this to maintain an extra element of stimulus in the market. So we're now starting to see this shift further and confirmed by the dots in March. Come May, we didn't get so much. May was quite a muted Fed decision, and in May we actually saw a slight stepping back from the dovish tone and the suggestion that the fall in inflation that they'd seen earlier on in the year may well have had transitory factors in it, i.e. could have been short term and therefore was not something that was necessarily going to be prolonged or would impact on policy going forward. That said, Powell maintained the patient language in making any further decisions. Now the June meeting, this was where the tip really came towards a dovish tone. Come June, we started to see yield curve inversion, suggesting that a recession was coming up. A yield curve inversion occurs where you have longer end rates lower than shorter end rates, i.e. you can borrow money for less for 10 years than you can for 2 years. So we're starting to see this inversion. This suggests that a recession is coming because the longer end lower rates suggest that they're not seeing any likelihood of the economy growing or a need for rates to be higher going further out. Uncertainties have increased was the language that they started to use as well. They dropped their reference to patient and instead changed that to the Fed would act as appropriate on rates and that it would monitor inflation going forward. We saw another big drop in dots, now suggesting that you're going to get a cut in 2020, and also that you had 7 members now wanting 2 cuts in 2019. So quite significant change in the dots here. We've moved from a hike in 2020 to now a cut. We're looking for 2 cuts potentially in 2019. Although the dot doesn't reflect this, the number of members that had shifted towards this was suggesting that this was likely to be the next shift from the Fed, essentially indicating that a rate cut could well be coming. What we then got was Powell at Humphrey Hawkins, and I'll show you the video in a moment and the key piece of language that he uses. What we'll also go and look at before then is a couple of markets that were traded on this, and I'll show you it in the video. But Powell's use of language at Humphrey Hawkins is what changed everything and suggested that a rate cut was almost imminent or almost certain in July, and made it very clear that that was the direction the Fed wanted to go in. So the markets that were traded here, and I'll show you the S&P and gold. Gold, one that we've not really talked about before, but gold links very well to the dollar. So any dollar weakness is a chance to buy gold. So from a trading perspective, if you're looking at a euro dollar ladder, you would expect gold to be moving in the same direction. Now the initial trade here is in gold. On Powell's comment, the trade then is dollar weakness, buy gold. So it's a smash and grab. Buy gold, looking for the first move here through the current trading range and up then towards 1402.4. Beyond that, you're then looking as far up as this range here, which trades from 1406 up to around 1410. So that's your ultimate larger target. Within 5 minutes, gold actually achieves the top of that range. But the initial trade here, and we're going to contrast the smash and grab with a continuation trade that occurs in the S&P. So gold takes on this first quick move. Here's your smash and grab trade up to 02s, up to 06s, and then a continuation through 06 right the way up to 14.7. So a lot of this is about picking the market to be going for. Because this is a statement and there could be lots more coming from it, as well as a Q&A, it's very much an interpretation trade. So hitting multiple markets is not necessarily the way to be acting on this. It's a quick reaction to his inflation comment that we'll see in a moment. Take that trade, and then once the rest of the comments are out, then you can interpret that fully and decide whether there's a further continuation trade. This then comes from the S&P. So the S&P initial move starts to take you up above 78, which is just getting up through these couple of highs here on the hourly. This is a 1 minute chart on the right. Starts taking you through 80s on the hourly. You've now got a nice clear target up towards 87.5, and a break of which then takes you up towards these highs at 3,002 to 5 area. This is achieved within around about an hour and a half of these comments. Market continues this grind higher, and this is where you then have to be looking, if you're playing a continuation trade, to accept this slower drift up, this slower move higher after the initial 5 or so minutes of aggressive repricing, as people start to price in that rate cut potentially coming. But once above 87.5, you can see there's 87.5s over here. Once above, that then allows for the continuation trade to be entered. So what we'll do now is we'll go and have a look at how this actually trades out and how to enter some of these trades. So what we're watching for first is gold. Gold down here, S&P to the left. Above gold we've got the euro, which equally rallies along with the T-note, and we'll actually see a trade executed in the Bund. This is a correlation play, correlating to the T-note. But the majority, or the main bit that we're going to focus on, is the smash and grab trade here. The smash and grab trade aims to get in before the gold reaches up towards 1397. Aims to get in. We'll see the initial little burst of energy as the information comes out, as the key phrase comes out from Powell, and then you see the continuation. Next up, we'll then move on to the S&P to see the continuation trade executed there, and how a position then is entered and built upon to get this continuation move. So there's the information. Gold starts to jump straight away, 1395 in before 97. The key piece of info that we're looking for here is that Powell says there is a risk of weak inflation will be even more persistent than the Fed currently anticipates. That means that the Fed's going to have to change their perspective. If they believe inflation is going to be weaker than they anticipate, then they're likely to need to change. Already we're seeing gold up towards 1400s, 00.6, quick flick up towards 1401.7, and this is where you're now starting to exit position. So you see the size dropping down quite rapidly now. We originally had 90 lots on this trade. S&P, not such a dramatic move. We're still seeing the euro pushing up towards its highs, and you've got a 300 lot chasing higher. T-note as well, just backing off its current highs at the moment. But this gold trade, we're now around about 2 minutes in, and the position is now starting to be scaled completely back, and there's the end of your smash and grab trade. Very quick reaction. Technically gold was good for this reaction anyway, but it was all on this risk of weak inflation being even more persistent than the Fed anticipated. So after the gold has reached up towards 1406, so that original little block area, it's now the time for the S&P, trying to get in for a continuation trade. So entering this trade around about the 2984s. The key area to be looking for now is a break above 87.5. Your correlated markets, euro still pushing on its highs, T-note still pushing on highs as well. So this is providing some confidence, some conviction that this is going to continue higher. Gold having a bit of a pullback, but gold is the fastest and most aggressive to initiate trade here. So gold starting to have a little bit of a pullback after a full 100 tick move to the upside. Euro and T-note still both pressing on highs. So we're now able to establish a position in the S&P, looking for a steadier continuation trade, which is why we're looking then to scale some out as the move drifts on higher, accepting that this is not going to be a ferocious move up anymore. This is going to be a much more steady move, a move that has continuation, but also with minor pullbacks, so the market's more likely to rotate back towards you. So what we're looking for here is something to help out and help the S&P move continue. We've built the position up to 140 lots now. The aim here being that if other markets start to continue the move, T-notes above 11, euro above 06, then the S&P is also going to be taking its cue from there. Building position further, looking for the break above 87.5. Once that breaks, that's a chance to scale something out as the market breaks higher. We're also now seeing gold back up towards the 06.4 into that range. So gold now looking up towards 10. This is a chance now to scale a bit of the S&P position out, but maintain in the position now as long as we're staying above 87. That was the break, that was the level on the hourly. We're also now seeing T-notes just ticked up at marginally higher towards 12s. And this is now where you have to start thinking to yourself, right, Are we looking for a much larger continuation trade? Is this a complete repricing? Is the Fed now completely shifting policy that the next decision is very likely to bring a cut and potentially change in policy further, or looking for further cuts going forward? So that's now the question that's on board. This is now what the market's going to be starting to try and price in. You can see gold still flicking higher, now up through that smaller range, up towards 1410. The next target in gold now is up towards 1414. So still a fair bit further. We've still got 40 more ticks to go in gold is the expectation, or if we can hold above 10, that will be where you're looking to go. So positions still being held in the S&P. And like I say, this is now a trade where you're looking for a steady, slower continuation. Expectations are not for sudden surge to see the market surging through highs, but as long as we're staying above 87.5, 87 area, a position can be maintained. Each time gold pushes up, we've seen the S&P continue with it as well. Each time the euro, and the euro less so, but the T-note ticks on, we're also seeing the S&P going. So position once more built on here to try and keep on that continuation move. So all the time just looking, each time we push through highs, because it's not likely to be a move that surges on and is likely to pull back, every break of a high is an opportunity to scale something out whilst trying to hold on to a core position. So this is how, or the distinction between a smash and grab trade that we saw in gold, quick in, target area up towards 02 and an exit, compared with a continuation type trade in the S&P, where we're looking then each time it moves through highs to scale some out and then try and add as the move comes back in, or add as other markets then start to break higher. So we're now into this consolidation phase in the S&P, sticking around the 80s or above the 87.5, moving up towards 91. Every time we're building up a position, to building up the size, but always looking to scale it as we move through the highs. Then as we come off, looking then to add back in as other markets add into this move, or add to your conviction on the move. This is how you keep that continuation trade going. This is how you then are able to stay in for that much, much longer, much more progressive move. If we go back to the charts, you can see the area that we were trading in. This was the area that we're trading in. And this is now where positions being built, steadies up somewhat here. Yeah, the energy really starts to fall out of this market. So this then becomes a question of, are you maintaining this larger view and going to sit with this and accept your stop below 87s and sit with that position, or are you then going to start coming out as that energy falls down? This is all about objective on the trade, of deciding whether you're going for the bigger continuation trade, or whether that breakthrough 87s was enough to be scaling out of this